We were talking earlier before the interview about your transition, and one of the places where you can make a difference is in terms of fees. And it's interesting in terms of how a pension plan can deal with costs. And we were talking in particular about Nortel Networks. They were 37% of the TSX, the Toronto Stock Exchange Index, and huge outsized risk for HOOPP at the time. But you were able to manage that risk in a very positive way. You gave me a big number of $800 million, $850 million. Talk me through that episode when Nortel had, tanked during the tech bust.
Sure. So we're a very big user of derivatives, one of the largest in the world, actually. Mm-hmm. And most people are scared of derivatives, but they're actually very, if you use them properly, they're very powerful risk management tools. And I think we're a very sophisticated user of derivatives. But so what we did at the time, Nortel became this disproportionate weight in the index, and at that time we had a bunch of outside managers as well. So when you start drilling down on all these portfolios, they all had Nortel in it. And so what we did is we did sort of an overlay on top of the thing using derivatives. So I was charged with sort of trying to keep our exposure below 5% of the fund. And so I used what we call a Costless Collar to do that transaction, which is effectively buying put options for if you like to sell a stock at a fixed price for a period of time. And then to pay for that, we sold call options, which about 15% above the market, which would cause you to actually force you to sell the stock if it went up by more than 15%. So it effectively capped our exposure within a range. And we did that in very material size because of the size of the exposure we had. And so I think it was around 2000, Nortel warned, and the stock went down, 30% in one day.
Right.
And so in that one day, that offset gained us about $850 million. So
$850 million, right?
Yeah,
And the thing is what you're talking about is reducing the volatility. That you still have exposure, but you're capping upside and downside, and that's part of the profile that you're talking about in terms of risk. This is something that you can do that individuals can't do. That's something
Correct.
that we're going to be talking about going forward.
Yeah, so individuals just wouldn't have the credit worthiness to do strategies like that. We're because of our size, we're extremely credit-worthy counterparty. So, Wall Street banks are very willing to deal with us, knowing that if when it comes time to pay, we'll pay. And so, whereas individuals, they would never do that strategy with because people can go bankrupt and they can't get the money from them. So.